B. Intrinsic value, book value, and market price. Intrinsic value is an all-important concept that offers the only logical approach to evaluating the relative attractiveness of investments and businesses. Intrinsic value can be defined simply. It is the discounted value of the cash that can be taken out of a business during its remaining life. The calculation of intrinsic value, though, is not so simple. As our definition suggests, intrinsic value is an estimate rather than a precise figure, and it is additionally an estimate that must be changed if interest rates move or forecasts of future cash flows are revised. Two people looking at the same set of facts, moreover, and this would apply even to Charlie and me, will almost inevitably come up with at least slightly different intrinsic value figures. That is one reason we never give you our estimates of intrinsic value. What our annual reports do supply, though, are the facts that we ourselves use to calculate this value. Meanwhile, we regularly report our per-share book value, an easily calculable number, though one of limited use. The limitations do not arise from our holdings of marketable securities which are carried on our books at their current prices. Rather, the inadequacies of book value have to do with the companies we control, whose values as stated on our books may be far different from their intrinsic values. The disparity can go in either direction. For example, in 1964, we could state with certitude that Berkshire's per-share book value was $19.46. However, that figure considerably overstated the company's intrinsic value since all the company's resources were tied up in a sub-profitable textile business. Our textile assets had neither going concern nor liquidation values equal to their carrying values. Today, however, Berkshire's situation is reversed. Our March 31st, 1996 book value of $15,180 far understates Berkshire's intrinsic value, a point true because many of the businesses we control are worth much more than their carrying value. Inadequate though they are in telling the story, we give you Berkshire's book value figures because they today serve as a rough, albeit significantly understated, tracking measure for Berkshire's intrinsic value. In other words, the percentage change in book value in any given year is likely to be reasonably close to that year's change in intrinsic value. You can gain some insight into the differences between book value and intrinsic value by looking at one form of investment, a college education. Think of the education's cost as its book value. If this cost is to be accurate, it should include the earnings that were foregone by the student because he chose college rather than a job. For this exercise, we will ignore the important non-economic benefits of an education and focus strictly on its economic value. First, we must estimate the earnings that the graduate will receive over his lifetime and subtract from that figure an estimate of what he would have earned had he lacked his education. That gives us an excess earnings figure, which must then be discounted at an appropriate interest rate back to graduation day. The dollar result equals the intrinsic economic value of the education. Some graduates will find that the book value of their education exceeds its intrinsic value, which means that whoever paid for the education didn't get his money's worth. In other cases, the intrinsic value of an education will far exceed its book value, a result that proves capital was wisely deployed. In all cases, what is clear is that book value is meaningless as an indicator of intrinsic value. An interesting accounting irony overlays a comparison of the reported financial results of our controlled companies with those of the permanent minority holdings. These holdings have a market value of over $2 billion, yet they produced only $11 million in reported after-tax earnings for Berkshire in 1987. Accounting rules dictate that we take into income only the dividends these companies pay us, which are little more than nominal, rather than our share of their earnings, which in 1987 amounted to well over $100 million. On the other hand, accounting rules provide that the carrying value of these three holdings, owned as they are by insurance companies, must be recorded on our balance sheet at current market prices. As a result, GAAP accounting lets us reflect in our net worth the up-to-date underlying values of the businesses we partially own, but does not let us reflect their underlying earnings in our income amount. In the case of our controlled companies, just the opposite is true. Here, we show full earnings in our income account, but never change asset values on our balance sheet, no matter how much the value of a business might have increased since we purchased it. Our mental approach to this accounting schizophrenia is to ignore GAAP figures and to focus solely on the future earning power of both our controlled and non-controlled businesses. Using this approach, we establish our own ideas of business value, keeping these independent from both the accounting values shown on our books for controlled companies and the values placed by a sometimes foolish market on our partially owned companies. It is this business value that we hope to increase at a reasonable, or preferably unreasonable, rate in the years ahead. Historically, Berkshire shares have sold modestly below intrinsic business value. With the price there, purchasers could be certain, as long as they did not experience a widening of this discount, that their personal investment experience would at least equal the financial experience of the business. But recently, the discount has disappeared, and occasionally, a modest premium has prevailed. The elimination of the discount means that Berkshire's market value increased even faster than business value, which itself grew at a pleasing pace. That was good news for any owner holding while that move took place, but it is bad news for the new or prospective owner. If the financial experience of new owners of Berkshire is merely to match the future financial experience of the company, any premium of market value over intrinsic business value that they pay must be maintained. Over the long term, there has been a more consistent relationship between Berkshire's market value and business value than has existed for any other publicly traded equity with which I am familiar. This is a tribute to you. Because you have been rational, invested, and investment-oriented, the market price for Berkshire stock has almost always been sensible. This unusual result has been achieved by a shareholder group with unusual demographics. Virtually all of our shareholders are individuals, not institutions. No other public company our size can claim the same. Ben Graham told a story 40 years ago that illustrates why investment professionals behave as they do. An oil prospector, moving to his heavenly reward, was met by St. Peter with bad news. "You're qualified for residence," said St. Peter, "but as you can see, the compound reserved for oilmen is packed. There's no way to squeeze you in." After thinking for a moment, the prospector asked if he might say just 4 words to the present occupants. That seemed harmless to St. Peter, so the prospector cupped his hands and yelled, "Oil discovered in hell." Immediately, the gate to the compound opened and all of the oilmen marched out to head for the nether regions. Impressed, St. Peter invited the prospector to move in and make himself comfortable. The prospector paused. "No," he said. "I think I'll go along with the rest of the boys. There might be some truth to that rumor after all." In the 1995 letter, with Berkshire shares selling at $36,000, I told you, 1. Berkshire's gain in market value in recent years had outstripped its gain in intrinsic value, even though the latter gain had been highly satisfactory. 2. That kind of overperformance could not continue indefinitely. 3. Charlie and I did not at that moment consider Berkshire to be undervalued. Since I set down those cautions, Berkshire's intrinsic value has increased very significantly while the market price of our shares has changed little. This, of course, means that in 1996, Berkshire's stock underperformed the business. Consequently, today's price-value relationship is both much different from what it was a year ago and, as Charlie and I see it, more appropriate. Though our primary goal is to maximize the amount that our shareholders in total reap from their ownership of Berkshire, we wish also to minimize the benefits going to some shareholders at the expense of others. These are goals we would have were we managing a family partnership, and we believe they make equal sense for the manager of a public company. In a partnership, fairness requires that partnership interests be valued equitably when partners enter or exit. In a public company, fairness prevails when market price and intrinsic value are in sync. Obviously, they wouldn't always meet that ideal, but a manager, by his policies and communications, can do much to foster equity. Of course, the longer a shareholder holds his shares, the more bearing Berkshire's business results will have on his financial experience, and the less it will matter what premium or discount to intrinsic value prevails when he buys and sells his stock. That's one reason we hope to attract owners with long-term horizons. Overall, I think we have succeeded in that pursuit. Berkshire probably ranks number one among large American corporations in the percentage of its shares held by owners with a long-term view. Calculations of intrinsic value, though all important, are necessarily imprecise and often seriously wrong. The more uncertain the future of a business, the more possibility there is that the calculation will be wildly off base. Here, Berkshire has some advantages: a wide variety of relatively stable earning streams, combined with great liquidity and minimum debt. These factors mean that Berkshire's intrinsic value can be more precisely calculated than can the intrinsic value of most companies. Yet if precision is aided by Berkshire's financial characteristics, the job of calculating intrinsic value has been made more complex by the mere presence of so many earning streams. Back in 1965, when we owned only a small textile operation, the task of calculating intrinsic value was a snap. Now we own 68 distinct businesses with widely disparate operating and financial characteristics. This array of unrelated enterprises, coupled with our massive investment holdings, makes it impossible for you to simply examine our consolidated financial statements and arrive at an informed estimate of intrinsic value. We have attempted to ease this problem by clustering our businesses into four logical groups. They are insurance, chiefly Geico, Gen Re, and National Indemnity; regulated and capital-intensive businesses, Berkshire Hathaway Energy and BNSF Railway; manufacturing, service, and retailing operations, which cover the waterfront; and finance and financial products, especially Extra, Court, and Clayton Homes. Of course, the value of Berkshire may be either greater or less than the sum of these four parts. The outcome depends on whether our many units function better or worse by being part of a larger enterprise, and whether capital allocation improves or deteriorates when it is under the direction of a holding company. In other words, does Berkshire ownership bring anything to the party, or would our shareholders be better off if they directly owned shares in each of our 68 businesses? These are important questions, but ones that you will have to answer for yourself. Let's review two sets of figures that show where we've come from and where we are now. The first set is the amount of investments, including cash and cash equivalents, we own on a per-share basis. In making this calculation, we exclude investments held in our finance operation because these are largely offset by borrowings. Year 1965. Per-share investments, $4. 1975, 159. 1985, 2,407. 1995, 21,817. 2005, 74,129. Compound growth rate 1965 to 2005, 28%. Compound growth rate 1995 to 2005, 13%. In addition to these marketable securities, with which minor exceptions are held in our insurance companies, we own a wide variety of non-insurance businesses. Below, we show the pre-tax earnings, excluding goodwill amortization of these businesses, again on a per-share basis. Year 1965. Per-share earnings, $4. 1975, $4. 1985, $52. 1995, $175. 2005, $2,441. Compound growth rate 1965 to 2005, 17.2%. Compound growth rate 1995 to 2005, 30.2%. When growth rates are under discussion, it will pay you to be suspicious as to why the beginning and terminal years have been selected. If either year was aberrational, any calculation of growth will be distorted. In particular, A base year in which earnings were poor can produce a breathtaking but meaningless growth rate. In the table above, however, the base year of 1965 was abnormally good. Berkshire earned more money in that year than it did in all but one of the previous 10. As you can see from the two tables, the comparative growth rates of Berkshire's two elements of value have changed in the last decade, a result reflecting our ever-increasing emphasis on business acquisitions. Nevertheless, Charlie and I want to increase the figures in both tables.